This is going to be a year of global change. We are going to see massive economic upheavals as we really are at the end of our fiat debt-based system. Welcome, everybody. Welcome to this edition of Crashes and Taxes. I am your host for this podcast, Rebecca Walser. So excited that you are joining us. Happy New Year. Happy 2024. This is our first podcast of 2024. This is our 101st podcast, and we're super excited that you are joining us today. We just have a technical update that we want to kind of go over and kind of give some foreshadowing to what we really feel is going to be coming this year, which is further banking crisis and liquidity problems. This is going to be a year of global change. We are going to see massive economic upheavals as we really are at the end of our fiat debt-based system. And so we are going to be bringing to you on a weekly basis all of the indicators on the contrarian side, because Wall Street is pretty much believes in this soft landing scenario that is not going to happen. And so we will be bringing you the indicators on the contrarian side, which will show you on a weekly basis that there is a problem with the system. The system is at its ending point. And as it might not be obvious at first, although we do expect some upheavals in Q1. It might take a little bit of time to start to see it, but once you see it, the whole world will eventually see it. So we're gonna be ahead of the fact, but let's go ahead and talk about the fact that we are gonna be on the front end of this, on the contrarian side, as opposed to what everyone else is going to see after the fact, and then be talking to you about after the events become obvious and they can no longer, sort of obfuscate them. This is a quote by Plato, which I love in any type of change disruptive period, because there are people that are going to see the disruption coming first. That's really kind of where we fall in our practice. And so to those who are able to see beyond the shadows and lies of their culture, they will not be understood. They will never be understood, let alone believed by the masses. So I'm very used to having people say, oh, it's not true, we're not going to have it happen, and yet it coming to fruition. So let's go ahead and get started. We had a major thing happen the last trading day of the year, which was Friday, December 29. And that was that, basically the secured, that what has replaced LIBOR, which is called SOFR. SOFR basically spiked overnight and during the day on Friday. And you can see that the repo errors, this is Bloomberg as of Friday, the repo era of calm is over as Fed pullback reignites volatility. It's finally happening. Curvature Securities Sherm says Fed's balance sheet unwind Treasury issuance will drive moves. So the era of calm and short-term funding markets is over after roughly 4 years of orderly trading. When banks and fund managers lock in funding at the end of each month, quarter, and year, volatility has erupted again. Gyrations and the repo rates sent one benchmark to a record on Thursday, while huge oscillations beset the market for short-term loans collateralized by treasuries. Overnight, general collateral repo traded as high as 5.6% on December 28th. Let's see. You can see this plot here that shows you from September 1 through December of how the overnight rate, which is the repo rate in red or pink rather, went to an all-time high on December 28, 29. The return of these violent swings is largely thanks to the Federal Reserve, which is removing liquidity from the system via quantitative tightening, or QT. QT is the opposite of QE. QE is when they inject cash in the system by buying the treasuries or the securities of banks. QT is when they are selling their treasuries off of their balance sheet. We know that their balance sheet is near $8 trillion. We're going to talk about that at the very end of today. I'm going to show you the trend so you can see that the 100 podcast that we did where we explained we went to modern monetary theory in 2008 is absolutely true and correct. And you're going to see that. You're going to see the scale about how fast things change and materialize in a country our size. So basically, QT is sucking cash out of the system. And because cash is getting sucked out of the system, the banks have to replace that cash that, basically in other mechanisms. That's reawakened volatility around these key funding periods when banks pair activity to shore up their balance sheets for regulatory purposes. Compliance reasons, they have to have so much in reserves. So forcing borrowers to either find alternatives or to pay up. At the same time, the government debt sales means more collateral that needs financing from the repo market. So basically, as these banks sell their collateral, we have to have cash, which means we have to generate cash from the repo market. It's finally happening, says Scott Schrim, Executive Vice President of Curvature Securities, within months of balance sheet runoff and massive Treasury issuance, because the Fed has been issuing treasuries, are obviously been buying treasuries. We're at the point when supply is creating more volatility in the market. I think 2024 to 2025 will have the volatility of 2018 and 2019. And 2019, we had some massive liquidity volatility issues, especially with the reverse repo market. So now you can see zero hedge here. This is also from Friday. SOFR suddenly soars to a record high as the key funding spread hits an imminent liquidity crunch. And here's what I want to point out to you. I don't want history to repeat itself, but it's going to. We are back into the banking era space of liquidity problems are going to make, especially some of the small and regional banks, are going to give us quite a bit of problems. Over a month ago, and well before the Fed's shocking dovish pivot, which was obviously at the end of last year, the Fed's overnight reverse repo tumbled below $900 billion for the first time since June of 2021, amid a growing debate of where and when the Fed's reserve scarcity constraint will be hit. We warned the liquidity is rapidly approaching the reverse repo constraint level, which could engage or emerge rather as soon as the RPP, a reverse repo facility, dropped to $700 billion, at which point the market's all-important credit plumbing will start to crack. So what's happening is exactly what we've talked about with the Federal Reserve and its quantitative tightening, sucking cash out of the system. What's happening is instead of banks basically doing reverse repo agreements with the Federal Reserve, they're actually selling off their treasuries or letting them mature, and then they're keeping that cash in the federal deposits, because they're getting 5.4% on their deposits with the Fed, as opposed to going into the reverse repo, which is making the reverse repo have a major liquidity crisis. I want to show this chart to you, which is this Federal Reserve's balance sheet with the Treasury General Account, the TGA, with reserve balances, with reverse repo agreements in the gold. What I want to show you is where and when our monetary policy changed. So you can see that we were really under $1 trillion on the Federal Reserve balance sheet. All the way from 2005 through 2009, we weren't even at $1 trillion. And if I pulled this chart out further and got you a chart going back to the 70s, 60s, we wouldn't even be at this 1 trillion. You can see that when quantitative monetary policy changed, when we went to modern monetary theory, really in the 2008 global financial crisis, you can see that our balance sheet immediately doubled and then rose further to 3 trillion. So we went from 1 to over 2, stayed at 2.5 for the next couple of years, and then rose by 2012. The beginning of 2012, middle of 2012, to basically 3 trillion. So what I want to point out to you is that as soon as we changed our monetary policy to MMT, we basically tripled our balance sheet within a matter of 3 years, from 2009 to 2012. The Federal Reserve's balance sheet went from 1 trillion or less than 1 trillion to 3 trillion. And then from 2014 on, we were above 4 trillion. So now we're at 4.5 trillion. So we went from 1 trillion for the whole of the entirety of our country's history to modern monetary theory in 2008, where we then tripled and then quadrupled our balance sheet in a matter of 3 years, maintained it at that level from 2014 all the way for 6 years to 2020, where we came back down just under 4 trillion. And then what happened? Coronavirus happened, where we jumped up to over 7 trillion and then got up to 9 trillion in 2022. And then some quantitative easing this last year came back down slightly, but you can see where we jumped back up in 2023 and then we're coming back down. The point is, we are now at over 7 to 8 trillion on our Federal Reserve's balance sheet, and it's staying at that level. This is how fast a country our size can literally go from maintaining $1 trillion of that level of notes and treasuries and securities on our balance sheet for many decades, and then we switch our monetary policy to modern monetary theory, which is a Keynesian policy of you can print however much you want and it doesn't matter. And the second that we did that, we were comfortable having 3x the balance sheet that we had had previous for decades. Then we were comfortable with 4x, and now we've been staying since 2020 at basically 7 to 8x. And now, if we have any kind of economic diminution of situations, if we have to use the Bank Term Funding Program, which is a dollar for dollar cash exchange for the treasuries that banks bought to collateralize their deposits, and instead of recognizing that those deposits are, or those assets are worth a lot less because the Federal Reserve has raised rates so much, now we're seeing that in fact we're used to this monetary policy. And so what is the impact of all of this? Where does this lead this year, and what will happen? And you can see this is an article out of Bloomberg just today, January 2nd, and it's talking about the global world now is starting to pause and say, wait a minute, we might not have the rate cuts that we have been expecting and sort of parsing in. You can see treasuries start year on the back foot as global rate cut bets ease. So now we're trying to say, okay, maybe we aren't going to get the rate cuts that all these central banks have sort of forecasted. The market is even pricing in more. Right now, the Federal Reserve is pricing in 3. The market is pricing in 6. And the market keeps having to price in faster. So now the market is potentially saying, instead of a March, we might have a January cut. A January cut would be an emergency federal meeting of the Federal Reserve. And so that would be nothing but terribly horrible news. And so that's why I'm telling you, the market is getting ahead of itself again, and you should really brace yourself for maybe us not having this massive global cut to keep liquidity on its toes. You can see that yields on U.S. and European government bonds rise about 10 bips, which basically means, hey, if yields are going up, that means the market is starting to discount as many rates as maybe we thought. The yields going up reflects doubts over the scope of interest rate cuts in 2024. U.S. Treasury yields rose sharply during a global bond sell-off as traders paired bets on deep interest rate cuts from major central banks this year. So what I just want you to know is that the market got really ahead of itself and is expecting 6 cuts. Now the market's trying to say, hey, we might have to have cuts as fast as January. That is not going to happen. The CPI read in Europe and the UK isn't even going to come until April. Us even cutting rates as fast as March, I think the data is showing it's not going to happen. And that's because we're going to have things that come out of Europe and Asia, and specifically China, before that. So I just don't see that happening. And there's other pricing parity issues that are also coming. And that is what are companies able to do now. And you can see that the consumer really tried to deal with inflation the best they could using their kind of COVID stimulus that they had still saved up in their bank or leveraging their credit cards. A lot of the trend that we saw in 2023, which is not really picked up by the credit bureaus, are these new companies that do, when you go to check out of your cart and they're automatically on there, Affirm, there's a couple of others that you guys would recognize. And it's not really, it's a soft, what we call a soft credit pull. So they don't really, you're not really applying for credit, but they check you to see if you have a minimum level of credit before they'll break your payment up in 3 or 4 or whatever amount of installment payments. And so basically what happens is that company is paying the merchant immediately their amount, and then they're taking and they're financing that with you over a course of time, and you're agreeing to pay a certain level of interest rate. Consumers have been very ingenious, a lot of ingenuity in how they've been able to continue to deal with inflation and higher prices. But now what we're noticing is that is ending, and what's happening now is that companies, because of inflation, because the inputs from Asia and all of the rest of the world have gone up in price as well, inflation from coronavirus still, that they're losing their pricing power, and that consumers now are starting to show that they are price sensitive and that they will not make purchases if the price is not right, which means that these companies are going to have margins impacted in 2024, and we will expect that as well. And then I'd say the final big surprise and the final big issue that we really are on the lookout for is these geopolitical risks. Unfortunately, with the Middle East, and specifically with shipping in the Middle East, we know that even the U.S. military actually took out some Iranian-sponsored ships in the Red Sea this last 10 days. So what we have is potential already, Maersk's already said they're not shipping through the Red Sea, but we have potential Red Sea disruptions. We obviously already have Black Sea disruptions, which is the sea where Russia's imports go through. And so we've got Russia and Ukraine with the Black Sea. We've got the Middle East with the Red Sea. And we have these conflicts. We also have Taiwan, and we have, information from China that they are looking to make sure that Taiwan is obviously clearly a part of China, and that also could lead to escalation. So we expect potentially geopolitical surprises to upset the economic outlook for 2024. And that is something that UBS also does agree with. Art Cashin, UBS Director of Floor Operations, and CNBC's Bob Pichon joined the exchange to discuss the market's performance in 2023 and the fact that geopolitical risks for 2024 will probably and most likely have a big market impact. So I just want to just pull this back to the highest level and just remind everybody that we always knew that the Fed, with such aggressive policies since 2008, the global financial crisis, since following monetary theory and having and maintaining such a large balance sheet, which would cause them to do quantitative tightening, which means they're going to sell off their balance sheet, pull cash in. Well, the problem with that is that Yellen has really financed reserves. She constantly is refinancing short-term debt treasuries into medium-term notes and bonds. So the problem is when you're financing your short-term collateral needs with longer-term or medium-term notes and longer-term bonds, you are going to create a liquidity crisis. And this is exactly what Yellen has set us up for. On top of that, we have the fact that we are quantitative tightening to get the balance sheet down so that we are pulling cash from the system. And that is happening at the very same time that rates have been discounted so much that now the actual cash withdrawals are moving into equities, creating more liquidity. We've had large liquidity withdrawals from the banking system because people are going back into the markets and leaving maybe their money market rates where they were getting 5+%. So we have a general liquidity shift from banks back to equities. At the same time, the Fed is still quantitative tightening, sucking cash in. At the same time that we're allowing things to mature so that we can get cash back into the system. So we do have a liquidity crisis. Now, this is going to bring a spotlight back to small and medium-sized banks. And we have also seen the Bank Term Funding Program, which is supposed to end in March. It's supposed to have that facility for the Federal Open Market is supposed to close in March. And if that closes in March, that's exactly when a lot of these obligations have to get refinanced. So we do not see how that facility will possibly be able to close in March, which will create further liquidity pressure in the system. So what I'm telling you is that the name of the game for Wall Street in these next 6 weeks is going to be liquidity and banks again, just like we had leading up to March of last year. Only this year it will be even a little bit more exacerbated because now we're talking about rate cuts and yields changing and all of that happening in a sea of the Fed also trying to get their balance sheet down. So this is all that we're dealing with right now. We will keep you abreast of this, but I just want you to be cautious and listen and really skeptically listen to those people on Wall Street that are saying that 2024 is going to be a bed of roses. We're going to have all these rate cuts. Everything's going to be great. We've got companies that are having a higher cost of capital that are having to refinance $2 trillion this year and next year. That's why the CEOs are so negative. We have 84% of CEOs basically saying in 2024 there will be recession because this is what they're seeing between global shipping disruptions, cost of goods going up so much from inflation, and the liquidity crunch and crisis that we've had from all of these central banks and all of their policies since 2020 coronavirus. It is going to be a very challenging year to achieve that soft landing. And in fact, we say there is no way that a soft landing is coming, and therefore we should be prepared for that fact. Until next time, you guys, take care, everybody. Have a great week.